Welcome to the fourth installment in Trading Strategy Guide's Trading Education Series. We believe the majority of traders end up losing money because they don't really know how the markets work, and they risk their money without the knowledge of the basics. Hang around and we'll talk in more detail about how markets work. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of our Trading Education Series. We as traders and trainers have fallen down on our jobs. We've allowed new traders to think that prices move up because there are more buyers in the market than sellers, and they move down because there are more sellers in the market than buyers. This is actually a fallacy. Every time there is a buyer, there is also a seller, and vice versa. I've used the example of the flea market before. You remember our seller Bob, right? You remember the ugly lamp that Bob was trying to sell? He's not going to actually sell that lamp without someone actually buying it. What drives the price up is if there are several someones all wanting to buy the one and only ugly lamp that George is selling. They now compete to buy the lamp by increasing their price bid until one of the buyers finally outbids the others and takes the ugly lamp home. Still, there was only one seller and one buyer. Limited supply and high demand caused the price to go up. Let's look at an actual market example. Here are two different cases. On the top chart we have the price of gold going up, and on the bottom chart we have the US dollar Japanese yen exchange rate going down. Some trainers will lead you to believe that the reason gold is going up is that there are more buyers in the market than sellers, and the reverse for the USD yen. The markets just don't operate like that. As I mentioned, there is one actual buyer for each seller and one actual seller for each buyer. You can see what these other trainers are trying to say. The market goes down when there are a lot of potential sellers, and the market goes up when there are a lot of potential buyers. That way you have traders bidding the prices up and down, but in the end there is only one actual buyer or seller. What really happens in the markets and what's behind the price movement is, number one, the price is going up when buyers are more aggressive than sellers, and number two, the price is going down when sellers are more aggressive than buyers. So what are aggressive sellers and buyers? Do we mean that somebody's going to start yelling at you and chase you down to get you to sell? Nah. We simply mean that aggressive buyers or sellers use market orders to open trades, which means that it consumes or reduces liquidity. Let's talk about liquidity for a minute. You'll hear this term frequently thrown about amongst traders. Investopedia defines liquidity as the ease with which an asset or security can be converted into ready cash without affecting its market price. In other words, you can think of a liquid market as one with a lot of supply available. The actual term is more complex than that, but that will suffice for the purpose of our current explanation. There are two main types of orders in any financial market. Forex, stocks, futures, cryptos, they all work the same way. And these two main order types are market orders, which take effect immediately. They tell your broker that you want in this market right now. Your broker then will get you in as quickly as possible at whatever the prevailing price is at that moment. It's like saying, I don't care how much that iPhone costs, I want it right now. Market orders are used by aggressive traders who want to get in post-haste, and they serve to reduce liquidity. Limit orders are orders that execute at a price designated by the trader. You're telling your broker that you want in this market, but only if you can get me in at this price or better. This is more like saying, I really, really want that car, but only if I can get it for less than $30,000. A limit order is used by traders who are only willing to get in at the right price, and they serve to provide additional liquidity. Again, these descriptions are simplified for our purposes right now. You'll find there are more details that are better left for a future video. The total amounts of an instrument that sellers want to sell represent the supply side of the market, and the total amounts of an instrument that buyers want to buy represents the demand side of the market. So in short, sellers are the supply side of the market, buyers are the demand side of the market. As I mentioned earlier, the market moves in the direction in which the market players are more aggressive. This is what causes the demand to be higher than the supply side. If buyers are more aggressive than sellers, the market will move up. Inversely, if sellers are more aggressive than buyers, the market will move down. This is what causes the supply to be greater than the demand side. The market will continue to move higher until there are no more buyers willing to drive up the market. In other words, the market will go up until the demand side dries out. Inversely, the market will continue to move lower until there are no more willing sellers to drive the market down. In other words, the market will go down until the supply side dries out. So, what does that mean to you? How can you use this information to make money in the markets? You now know the market is moved by supply and demand imbalance, and that's driven by aggressive traders using market orders. These aggressive traders need to clear all the limit orders to move the market. With this information, you can now understand what happens when the market makes a new low and reverses higher, or what happens when the market makes a new high and then reverses lower. You can also predict where it's most likely to have supply and demand imbalances. In other words, as an order flow trader, you should now think along the following lines. At what price can you expect a massive limit order to be placed that will stop aggressive buying and selling pressure? Trading with an order flow mindset means that you now need to put together a puzzle where you use small pieces of information to build a bigger understanding of what drives the market. Let's look at an example. In this example, we're going to focus on what happens from the standpoint of supply and demand when the market makes a new low and then reverses. In this chart, the gold price is going down. You should now understand what needs to happen in order for the market to stop and reverse. You should know what needs to happen between the supply side, in this case the aggressive traders, and the demand side, represented by passive traders. Let's first look at the gold chart. The price is going down after it creates a double top pattern here. The sell-off is now visible to all market participants. Now, many aggressive traders will be selling because the market is going down very quickly and they believe it will continue trading down. Other indicator-based traders will join the sell-off later because the lagging nature of these indicators will trigger a trade well after a move is put in motion. This confirms that there will likely be more traders pushing the market down. But are these aggressive sellers? Probably not, because these sellers are most likely small retail traders who are wrong most all the time. We've learned that for every sell order there must be a buy order. More than likely the counterparty of these sellers is the smart money or big money institutions who use limit orders to get in the market and absorb the liquidity. We call them the smart money because they understand the concepts of supply and demand and order flow and use that information to make their trading decisions. For example, let's say that after we broke below this intraday swing low, 500 buy limit contracts show up at a price just below that level. Let's say in our example that there are enough aggressive traders to sell 200 of those 500 buy limit contracts, but there are 300 more left unsold. Since there are no more aggressive sellers to fill those contracts, it means they are not able to absorb the rest of the buy limit orders. The price stops moving down because we ran out of sellers. Everyone who wanted to sell has already sold. In other words, there's no one left to drive the price lower and the supply side is drying out. Meanwhile, aggressive buyers are now stepping into the market, driving the price higher and attracting more buyers to buy, causing an increase in the demand side. The buyers are now in control of the market as the demand side is more aggressive. Now everyone who previously sold, expecting lower prices, has their position in jeopardy. Many of the previous sellers have their stop loss placed above the double top pattern because that's what technical analysis textbooks tell you to do. All the collective stop losses above the market are now considered to be a pool of liquidity. Since we've learned that for every sell order there must be a matching buy order, these pools of liquidity will attract those buyers to unload their positions. Once these stop orders get triggered, they will become market orders because that's how stop loss orders work, and they now have the potential to trigger a price cascade that will reinforce the upward price movement. These are the basics of how supply and demand work in the financial market and the reasons behind any price movement. Remember, the interaction between market orders and limit orders is what moves the price of all markets. The price moves in relation to the number of market orders versus the available limit orders. I know all of this is pretty tedious and probably somewhat confusing, but be patient because the more you study about order flow, the better you'll understand the markets and the better trader you'll become. In short, the price of any market moves because of the supply and demand imbalances and because of the buyer and seller aggressiveness. That's it for this video. Thanks for watching and subscribing. If you have any questions, leave them in the comments below, and be sure to come back for my trading picks videos on Monday and Friday, and of course next Wednesday for the 5th trading education series video entitled The Game of Trading. Have a great hump day, and I'll see you next time.